We all see the headlines. The AI boom is printing money. But what if I told you there's a multi-billion-dollar question hiding in the accounting of all these tech giants? The question is, are these incredible gains actually sustainable? Welcome to the GPU depreciation game. The earnings reports from AI leaders are, frankly, spectacular. They're grabbing all the attention. But what if they're supported by an accounting strategy that's just kicking a massive financial risk down the road? Let's just get right to it. Are these profits really built on borrowed time?
All right, here's how we're going to break this down. First, we're going to unpack what's called the AI profit paradox. Then, we'll take a look inside the GPU cash machine to see how it all works. After that, we'll hit the big problem, the performance cliff. Then, we'll put accounting and reality side by side and wrap up with what you, as an investor, need to look for in your own due diligence.
Okay, let's dive right into the core issue. The big cloud providers, your Amazons, Googles, Microsofts, they're depreciating their GPUs on their books over 4 to 6 years. But here's the rub. The pace of AI innovation is so fast that the actual useful economic life of these expensive chips could be much shorter. And that disconnect, well, that creates a hidden and potentially huge financial risk.
So, you're probably asking, how are they able to do this? How does this work? Well, it all comes down to the absolutely incredible economics of the GPU rental market right now. Let's just look at the numbers. What you're looking at here, this is the engine making it all possible. Just focus on that massive gap between the revenue they bring in per hour and the actual cash cost. For a new, top-of-the-line chip, a company makes about $3.30 in revenue every single hour it's rented out, and the cost to run it, power, cooling, is just 45 cents. That difference isn't just a profit margin, it's a cash printing machine. And that massive gap translates into this number, an 86% contribution margin on a new GPU. That means for every single dollar of revenue, 86 cents goes directly to paying off the price of the chip itself. Even for an older chip, it's still 70%. These are the kinds of margins that make the whole financial model work, at least for now. And here's the key takeaway on the cash side of the equation. With margins this juicy, these companies can get their entire investment back on a very pricey GPU in as little as 18 months. That super fast payback gives them the financial cover they need to justify stretching the depreciation out over a much longer 4 to 6 year period for the accountants. But, and this is a big but, here's the catch. While the cash flow looks amazing, technology doesn't wait around. We need to talk about the performance cliff, because older GPUs are becoming obsolete and it's happening really, really fast. This slide gets right to the heart of the problem. It's all about price to performance. Think of it like this. How much computing power, how many flops, does a customer get for every dollar they spend? And as you can see, with every new generation of chips, the bang for your buck just gets exponentially better. I mean, just look at the raw numbers. A customer renting a new chip gets 1.6 E-flops of performance for every dollar. With an older one, they're getting just 0.72. You're getting more than double the performance for your money on the latest hardware. Now, who wouldn't take that deal? This is what absolutely crushes the rental value of older models, making them economically obsolete long before they physically wear out. And all of this brings us to the central conflict, doesn't it? We've got this widening gap between the value of these GPUs on a company's financial statements and their actual economic value out there in the competitive market. This slide really puts the whole conflict into one picture. On the left, you've got the calm, orderly world of accounting. Nice, predictable depreciation schedules of 4, 5, even 6 years. And on the right, you've got the brutal reality of the market, where performance per dollar doubles at a crazy pace. Those two stories just don't match up. And look, this isn't just some theory. These are the actual numbers from their public filings. Google uses 6 years for its servers. Amazon, 5 years. Meta and Microsoft are right there in that 4 to 6 year range. This is the industry standard practice we're talking about. So just to be crystal clear, what we're really focused on is the asset's economic life. This concept is key. It's the period where the asset is actually competitive and useful. And thanks to technological obsolescence, that can be much, much shorter than its accounting life. Now, this isn't fraud. It's a strategic accounting choice, but it's a choice that comes with some very real risks. So what does all this mean for you and your portfolio? How can you actually gauge this risk? Let's pivot to the key metrics you absolutely need to have on your radar. All right, here are the canaries in the coal mine. You need to watch GPU utilization rates. If they start falling, it means customers don't want the older chips. Be on the lookout for any company shortening its depreciation schedule. That's basically an admission that things are losing value faster than they thought. Rising impairment charges are a direct write-down of that lost value. And of course, keep an eye on the actual rental prices for older GPUs and watch for rising operational costs like power. And if there's one thing to take away from all this, it's this quote right here. Longer lives boost near-term accounting profits, but they also raise the risk of future impairments. It's the classic trade-off, isn't it? Make the income statement look great today, but at the risk of taking a big, painful hit tomorrow if technology moves faster than you bet on.
So this all brings us to our final thought. In this massive AI gold rush, the big cloud companies are the ones selling the shovels. The critical question for every single investor is whether they're accounting for those shovels properly. Answering that question correctly could be the difference between striking gold and getting stuck with a pile of very expensive, very obsolete hardware.